Hello and welcome to Revision Tips for SIPS Level 5 Advanced Diploma in Procurement and Supply. This is Module 4, which is Advanced Contract and Financial Management, and it's Learning Outcome 2, which is to understand and apply the concept of strategic sourcing. So here we'll assess the market factors that influence strategic sourcing, the assessment of sourcing options for our strategic suppliers, and the strategic assessment plan for the key suppliers using modelling and analytical techniques. So what we can see here is Porter's 5 forces model, which is looking at the industry, because an industry will consist of a group of establishments that are engaged in the same or similar kinds of production activity. And the market is where buyers and sellers come together to buy and sell products or services. The term industry is often used as something that indicates a market, I guess. And strictly, there are different concepts. So an industry structure is not static for the following reasons. Over time, buyers and suppliers can become more or less powerful. Technology or managerial innovation can make new entry or submissions more or less likely. Changes in regulation can change the intensity of the rivalry or affect the barriers to entry. And strategic decisions by competitors like pricing and distribution can also affect the path of industry competition. So the Porter's forces model is a tool for understanding the supply market and the competition, used for strategic sourcing and the development of general purchasing and supply management. And a 5 forces analysis is used for anticipating and exploiting industry structural change. So the 5 force framework was originally developed as a model for understanding the likely profitability of an industry and understanding the market dynamics. But digitalization, globalization, and deregulation are developments that influence the 5 forces, but don't necessarily change their relevance. So these questions are the ones that need to be answered. Are companies entering or leaving the market? Are there substitute products, or are they likely to be in the future? Are the suppliers of the industry powerful? How fierce is the competitive rivalry of that market? Is there price competition, branding, or technological development? Is there excess capacity? And is there likely to be consolidation where companies merge or exit the market? Now, each area is now assessed in terms of the impact on the buyer. So we need to determine the scope of the market. This should not be narrow, so it misses important factors. We should identify all relevant forces in the market and analyse them, examining the current and future potential state of each of the 5 competitive forces. This should not be a static analysis. And then identify any options to influence the market in your organisation's favour, and that's either by reducing the power of the competitive forces or by selecting a competitive strategy that takes these forces into account. Now let's look at how the steepled factors can influence industry dynamics. So socially, people's attitudes can change, and out there, trends and fashions and everything else can change. Technology moves at pace. And if you're not adapting to new technology, or if you're relying on old technology, you could potentially lose your competitive advantage. Things economically that change in terms of inflation, deflation, tax, and environmentally, the attitudes towards sustainability do change over time. Politically, our government structure changes. We can be perceived as stable or unstable, but it also links to our international agreements. Legally, it's about complying with the regulating bodies, and the laws can change over time. Ethically, some businesses will get squeezed out of the market because they're not behaving ethically. And demographically, this comes down to gender differences, population shifts, and the way that people are making up our population. Now, the price elasticity of demand, or elasticity, is the degree to which the effective desire for something changes as the price changes. In general, people desire things less as those things become more expensive. So the main factors that affect pricing is the value perceived by the customer, the production costs, the level of competition and other market considerations, the strategy and objectives of the organisation. But I guess organisations within the same industry may have very different pricing objectives. So you've got cost-based pricing, which is a process of setting prices that reflect the cost of production, distribution and sales, with a percentage markup to cover the effort and risk involved. And those options include cost plus, break even, and even target profile pricing. Or you could do a customer value-based pricing, where the buyer's perception of value is set in the prices. So competition-based pricing considers these strategies, the cost, the price, and the market's offering of the competitors. So skimming means prices of the product is set high in comparison with similar goods, then gradually reducing the price so an organisation can rapidly recover its cost by maximising its initial sales revenue. Penetration pricing is the complete opposite. Pricing is set low in comparison with the similar goods or service in an aim to capture a large market share, which will later allow the company to raise the price of the product or benefit from economies of scale. Psychological pricing means pricing a product using prices that marketeers believe have a universal appeal. For example, $9.99. And then loss leader pricing means pricing a product very low to attract new business and win market share from your competitors. A competitive pricing strategy of this kind sacrifices profits in favour of market share. Now, pricing behaviour also includes when and how prices are adjusted. Prices that rarely change are referred to as sticky. So price stickiness is caused by fixed price contracts. But O'Brien has produced a pricing model identifying 6 different pricing approaches. Firstly, greed. The supplier has the power to set the price and charges a price that's unrelated to the cost. The second is value. Customer value-based pricing uses the buyer's perception of value rather than the seller's cost to determine the price. The third is budget, and price is determined by the size of the buyer's budget. The fourth is cost. A margin is added to cost to determine the price. The fifth is market, and the market sets the price. In a perfect competition market, the organisation will be the price taker due to the market setting the price. And the final 6th one is the target price. The buyer gives the supplier a target price that must be met or exceeded. So it's essential that potential suppliers are financially appraised at early stage of the sourcing process. And if a buyer agrees to a contract with a financially unstable provider, this could result in a number of issues if the supplier is forced to cut cost to make their profit or even just survive. And this can include interrupted supply or decreased product quality. So when conducting supplier financial appraisals, you should consider the profits, cash flow issues, ratio analysis, debt, and equity. So we're now going to look at profitability ratios. Now, there are 2 main profitability ratios that you need to be aware of, which are the ones at the top. So we've got gross profit margin and net profit margin. So gross profit simply is looking at how much your company has turned over and deducting the cost of sales. That will give you your gross profit. You divide it by your revenue, times it by 100, and ideally this should be over 20% because it hasn't taken into account any overheads. The net profit margin would be going that one step further, not just deducting the cost of sales, but also your overheads in terms of your salaries, your rents, your insurances, and all sorts. So you have your net profit divided by your sales revenue to give you a percentage which should ideally be above 15. And the purpose of these is to demonstrate an organisation's ability to convert sales into profits. But they also help to determine the organisation's ability to manage its cost base. Now on to liquidity ratios. Liquidity ratios calculate if an organisation has sufficient current or short-term assets to meet its current or long-term liabilities. So it's calculated by dividing the total current assets by liabilities. And a ratio of more than 1 to 1 is desired, as this means the business has more assets than its liabilities. And I guess my easier way to explain this is that an asset is something you own. So you own it, lock, stock and barrel. It's yours to do whatever you like with it. You can sell it, you can keep it, but it has a value. And then your liabilities is what you owe. So the money you owe to other people through loans, accounts payable, bills, whatever it might be. So a good liquidity is where you own more than you owe. So the current one simply looks at your total current assets, which does include your fixed and current assets, so that's your buildings, your machinery, your vehicles, as well as any stock, because again, stock is an asset. And then you divide it by how much you owe. This ideally should be lower than 1 to 2. It should not be lower than 1 to 2, sorry. So it means that you own twice as much as you owe. With the asset test one, though, it actually removes the stock from the equation. So it just physically looks at your fixed assets, your buildings, your vehicles, your machines. Remove the stock from the equation and then divide that by your liabilities, because stock moves very, very quickly. And it's very difficult to turn that into cash quickly either. So ideally, if you do an asset test, it needs to be not lower than 1 to 1. So you owe as much as you own and no more. And finally, gearing and return on investment ratios. Now, gearing is the proportion of an organisation's long-term borrowing against its equity. And it's calculated by dividing your long-term debt by your shareholder equity. And high gearing means a lot of long-term debt, which may present a risk, especially when interest rates are rising. So your long-term debt is your mortgages, your loans, all those sorts of things. You add in your short-term debt, which is any accounts payable, any overdrafts that you might have with your bank, and then you divide it by how much shareholder equity you've got in the business. So let's say you've got £500,000 worth of investment from shareholders. Your gearing should never be more than 50%. So if you've got 500,000 of equity from shareholders, you should never have more than 250,000 in debt. A highly geared company is not a good ratio, because you always have to pay your debts back. The shareholders only ever get paid back as a return on investment as part of their dividend share at the end of each year. And the ROI, the return on investment ratio, is used to measure the performance of the business in terms of the profit it generates relative to the amount of money that's been invested in the business. So it's calculated by dividing net income by total assets. And the ROI ratio should be as high as possible. Now, there are some limitations to the ratio analysis. The data used is historic, and it may not give a current and actual result. An organisation could have recently been increased in terms of its assets or liabilities, and the ratios will not reflect it. The current rate of inflation is not taken into account either. And they don't show the reasons for the trends for seasonality. But if an organisation has recently been involved in a merger, the ratios may appear unfavourable. And the information is purely numeric. It needs supporting with other data. And also the accountancy methods can vary. Now, it's important in strategic sourcing to recognise how a change in demand and supply factors can affect an organisation, but also its suppliers and its customers. The supply market can be broken down into smaller groups based on the location, the type, service and size, financial stability, the price points they're at, capabilities, specific expertise, and their commitment to sustainability. And a buyer's approach to the market will be determined by understanding whether or not the supplier has capacity and capability in the market to supply the goods and services. Now, the supplier preferencing model, which you can see on the screen, was developed by Steele and Court in 1996. It allows the buyer to understand how suppliers view the buying organisation and its requirements. It has two axes: attractiveness of account and relative value of business. These produce 4 quadrants that reveal how a supplier might view a buyer. So let's go top left. You're an attractive account, but you're not spending very much money with them. So you fall into what we call the development quadrant. The buyer's response might be to move into the core quadrant by rewarding the supplier's efforts with additional business. But the core quadrant, where you have an attractive account and you're spending lots of money, your response could be to review regularly to ensure the position as a core customer is maintained. Bottom right, exploitable, where you're spending lots of money but you're not an attractive business. That could be because you don't pay them on time or you always ask for everything last minute. So your response here could be to try and move into a core quadrant by looking at areas of business that supplier might find attractive, like being involved in a prestigious project. And the nuisance category or quadrant is where you don't spend much money and you're not an attractive business. So the buyer's response could be to try and move into a development quadrant by looking at areas of the business the supplier might find attractive. Now, internal stakeholders will need to be involved in strategic sourcing. We need to identify stakeholders and their roles and responsibilities. We'll need to ask, who is responsible for the activity? Who is accountable? Who needs to be consulted? And who needs to be informed? And this is known as the RACI model, which you can see on the screen. So in terms of responsible, the person or stakeholders who do the work, they need to complete the task or objective or make a decision. Several people can be jointly responsible. Accountable is the person who owns the work. He or she must sign off and approve the task, the objective or decision. And they must ensure that responsibilities are assigned in the matrix for all of the related activities. Success requires that there only be one person accountable. Consulted are the people or stakeholders who need to give input before the work can be done and signed off. These people are in the loop and active participants, whereas the informed category just need to be updated on progress and decisions. They don't need to be formally consulted, nor do they contribute directly to the task or decision. You can use the Mendelow's matrix to identify how to engage with each group of stakeholders depending on their relevant power or interest. Stakeholder power is the ability to influence events, and interest, which is the impact of the decision that it's going to have on them. But missing from this analysis is whether they are for or against the project. But nonetheless, if a stakeholder has a lot of power and interest, these are your key players. You must manage them closely. Whereas if they're high power and low interest, you need to keep them satisfied. High interest, low power, keep them informed, but only minimal effort is required if they have low power or low interest. Now, purchasing contracts can be classified according to their purpose, type of price arrangement, and the time period. The type of purchase will influence the type of contract used. So what you can see on the screen here is an example of the NEC4 suite of contracts, which is suitable for procuring a full array of works, services, and supplying range of small-scale projects of purchasing the goods and supplies all the way up to major framework projects. And they come with different pricing mechanisms. So option A is where you price the contract with an activity schedule. So if you know exactly what it is you want, that one's the best option to go for. Or you could price it with what we call a bill of quantities. So again, you're going to need to know exactly everything that you want to buy to make that work. And option C is a target contract. Again, you've got an activity schedule, but it's not necessarily priced in the same way that option A is. It's almost a target cost. And the same with a D with the bill of quantities. Option E is where you have a cost reimbursable contract. So you cover the supplier's cost plus a bit of fixed overheads and profits. Option F is for management contracts. And option G, term contract for the appointment of a consultant based on a price schedule of tasks. Here are some other generic pricing arrangements as well. So you've got your firm fixed price where the price is set and fixed by unit of measure of product. Fixed price economic adjustment is where you provide for an adjustment according to specific contingencies, like, for example, an increase in minimum wage. Fixed price incentive provides for a profit adjustment according to a formula based on the total target cost. Cost plus award fee. Your base fee plus an award fee is determined according to individual milestones. And a cost plus incentive is when you reimburse the supplier for its cost and you add on top a negotiated fee. There's also time and materials where payments are based on suppliers' hourly rates and the cost of materials, and a cost plus fee where you reimburse the supplier for its cost, again when you add a negotiated fee on top. Now you may need to pause this slide to actually get a good look at the advantages and disadvantages here, but contracts are used for a specific period of time rather than being open-ended. And three duration types are spot, short-term and long-term. Spot contracts are for daily, weekly or monthly requirements only, and the relationship is only for the duration of the contract, and it's often what we consider to be arm's length. Short-term ones are for more routine purchases and maybe for leverage items. They give the buyer power over the supplier as they can encourage competition. But this prevents close working relationships from being established, so they may not be suitable for strategic items. And then we've got your long-term contracts that last for several years and are used for strategic and bottleneck items. So you'll be establishing and maintaining a mutual rewarding relationship with the key supplier, and that can enable an organisation to achieve long-term cost savings by reducing issues and availability, as well as qualities and delays in supply. However, opportunistic suppliers may be advantageous to the buyer and the prices may become uncompetitive. So this is where you can see the advantages and disadvantages. So, you get the assurance of supply, you can lock in an agreed price. The supplier could provide you with access to technology and maybe you're more willing to invest in skills. They work together to improve the processes and reduce waste, lower the costs. And it may also broaden the awareness of business technology that's being shared. You get the stability of volume production, and you can build in inefficiencies into the supply chain, eliminating any unnecessary costs. But the downside is you could select the wrong supplier. Price may become uncompetitive. It's difficult to exit if the contract has not been correctly drawn up, and you lose these opportunistic suppliers. It might limit your ability for a seller to respond to new or emerging markets. Suppliers can become complacent and uncompetitive, losing motivation. Limits your opportunities to take advantage of any spot or short-term market volatility, and limits the ability for the buyer to develop alternative supply. The contract can become complex and therefore expensive to draft. So just be aware of some of the advantages and disadvantages, because it could come up as a question in the exam. Now, competitive procurement involves opening the market and the process of bids and tenders in order to get value for money through supplier competition. Whereas non-competitive procurement is sometimes called sole or single sourcing. Sole sourcing is where there is actually only one supplier available in the market, whereas single sourcing is where you choose to only work with one supplier. Now, the number of suppliers will depend on whether the supply chain is tiered and whether there is a single or multi-sourcing used. Supply chain tiering can be widely adopted across the automotive industry. And if a supplier's chain is tiered, the OEM, which is the official equipment manufacturer, will have only a few direct suppliers to manage. That will be their tier 1 suppliers. And the tier 1 suppliers are responsible for managing the second tier, and so on. This allows for more collaborative ways of working and enables companies to focus on their core competencies to deliver their competitive advantage. But the decision whether to single or multi-source should result from a purchasing portfolio analysis like CrowdCheck. A successful sourcing strategy will typically involve either one close ally or many suppliers. And that's in order to guarantee that the buyer is consistently able to source the required products. And to obtain both methods of sourcing, buyers should apply significant pressure to single source suppliers or provide significant certainty to multi-source providers. So again, you might need to pause this slide to have a quick look at what these benefits are. Some of the main benefits to single sourcing is that you can build a better relationship, reduces the risk of opportunities, substantial commitment from that chosen supplier, maybe better innovation, research and development, lowering your costs because the supplier can get a better economy of scale. Your bargaining power increases, and it makes the effort and administration worthwhile in managing that relationship. But you are highly dependent on them, which increases your supply chain vulnerability and risk of interruption. And it's about remaining competitive, and this is difficult if the buyer is tied to a single supplier. So let's look at the multi-sourcing advantages. There's lots of different ways that you could source what you're looking for. Reduced probability of bottleneck suppliers, better competition, greater flexibility to react to unexpected events. Buyer can meet their local sourcing requirements, and a low volume business with the buyer may reduce the efforts made by each supplier to match the buyer's requirements. But the downside is that you will have higher costs for the buyer because more calls, more phone calls, more meetings. Higher costs because you've lost the economies of scale, and can be a source again of variability. So for strategic sourcing to be successful, a selection of suppliers, including vetting, requires careful consideration. So the purpose of vetting or evaluating a supplier's pre-contract engagement is to ensure that the potential supplier will be able to perform any contract that's awarded to the required standard. For strategic sourcing, some of the points that need to be considered are the technical capabilities. Can they actually produce the goods or service? We then look at their financial stability, like the financial ratios we've already mentioned. We can look at their management and quality systems, such as do they have accreditations to ISO 9001, which is the quality management one, and 14001 for the environment. We can consider their business terms like payment, delivery, service levels, and its policy on returns. Look at their current customers. Try and get feedback from past and current customers and seek references. Look at their policies on corporate social responsibility and ethical sourcing. It is important to check what policies they have and making sure they're robust. And the final vetting strategy might be to conduct a site visit, which can produce first-hand knowledge of how they do business and how they maintain their site. Okay, e-sourcing. E-sourcing is electronic sourcing, so using software to help us to engage, deliver the quotes and tenders, evaluate, all the way through to contract. So you'll be looking at storing your knowledge, pulling together a specification, whether that be a performance or conformance-based specification. You might have templates within the system. How you can run your request for quote or your ITT tender. You could even negotiate using e-sourcing, especially if you've got a module for e-auctions. That's another nodule on the back of an e-tender or an e-quote. But even then, you could just do, online evaluations if you were looking at static bids, all the way through to developing a contract for signature. And this offers improved productivity through efficiency, but they are expensive to install. But e-sourcing provides electronic support for 6 core processes, which you can see on the left: business intelligence, configuration, supplier search, supplier and product authentication, and evaluation. But in terms of the advantages and disadvantages of e-sourcing, the good side to this is that it does enable integrated process automation. So it means that the systems and processes are connected electronically, and as a result, the amount of paper you use is going to be reduced to the minimum. It can help to simplify analysis and model complex decisions in real time, facilitating collaboration with suppliers through central systems that support communication and the exchange of information and documents. But the downside is there can be some resistance to implement e-sourcing. Major changes are often difficult to implement due to resistance or organisational culture. The creation of catalogues is a long and costly process for suppliers, and it can increase the risks associated with losing control over information and confidentiality, as well as the security of payments and data protection. Now, competition is a useful tool for strategic sourcing. Suppliers may be asked by a buyer to compete for its business, and suppliers can be pre-selected in a restricted process or the bid process itself. And in the UK, the public sector's preferred route is competition because it needs to be open and transparent. But the alternative to this is direct negotiation, where you discuss your requirements either with one supplier or with a small group of suppliers, and the aim of negotiating is a lower price. But it can commence before or after the initial offers or quotes are received. A should cost analysis may be carried out prior to the negotiation. And using the total cost of ownership approach is a good strategy when you're negotiating, because what you're doing there is selecting suppliers who offer the best total cost of ownership rather than selecting based on purchase price alone. But direct negotiation is a tool to be used in strategic sourcing. It can shorten the route to getting the right purchase price, but most importantly, in having a buyer and seller to come face to face, the human interactions of understanding and explaining can be key to obtaining a positive outcome for both sides. And a joint proposition is a proposition for a buyer and supplier to work collaboratively together in order to improve a situation for mutual benefit. So, for example, processes or requirements may be modified to reduce the supplier's costs, and some of these savings can be passed on to the buyer. But it may involve an informal partnership that leads to improvements in processes, products, services and offerings, or it could be a formal partnership. Now, supplier selection is normally associated with new suppliers, although it can be conducted with existing suppliers. The result of any supplier evaluation is usually some form of rating or score, which will identify the most suitable and capable supplier. Supplier evaluation can be used as part of a supply-based reduction program, where suppliers are ranked and only the top few suppliers get selected. But it can also be used as part of supply development to identify suppliers who are suitable for or who need development. Now, Carter's 10 Cs is the most common approach on the right-hand side. There are Lyson and Farrington and Monseca, which is in the middle, but I'd say the most common model to comment on in an exam would be Carter's 10 Cs, which goes through, firstly, competency, looking at whether or not the organisation is able to supply the product or service. Then on to capacity, do they have capacity to meet your current but future demands? Their commitment to quality, do they have a quality policy, an ISO 9001, or a commitment to its success like a quality management system? Has it got consistency of performance? Can they deliver consistently high levels of quality throughout the life of the contract? In terms of cost, what is the total cost of the product and service? Does the supplier remain profitable? From a cash perspective, are they financially stable? Communication. Can the organisation set up and manage appropriate channels of communication between the stakeholders? In terms of control of its internal processes, can they manage and control key processes like the 5 rights? Corporate social responsibility, is the organisation compliant with good ethical and legal practice, or are they kind to the environment? And finally, culture. Does the organisation share the values of the buyer? Now, criteria that may be used to assess a key supplier could include their capacity. So, for example, quality, finance, research and development, IT systems, performance, the volume and level of productivity, but as well as capability, which is more about resource capacity, including the facilities and the people, as well as the inputs and the outputs. Moving on to planning, this relates to the systems control and organisation's workflow, which releases schedules and flow of work within the organisation, as well as its external partners. The quality control system, a buyer cannot rely on the supplier's ability to perform properly, and problems inevitably arise that potentially could delay production. And a supplier's ability to deliver adequate quality may be assured by requiring it to have a third-party accreditation, like ISO 9001 or a quality management system. Security needs to be assessed by the nature of the contract. It can relate to physical security, information security, financial security, or simply just continuity of supply. Technical expertise. This is closely related to technical capability and capacity. So if the supplier has experience in producing similar goods and services, it can be assumed that it has the relevant technical capability and experience. Reputation and time established. So you can gather testimonials or references, and that can help, but it is hard to bridge the gap between reputation and expectation. Other indicators could include looking at the history, whether the business is family owned or had a previous lawsuit against them, but also their current position in the market and their supply chain partners. Investment plans, what are their plans for capital investment to take the business forward? Do they have a technical roadmap? Do they lease? Do they buy? And in terms of trading with competitors, this can influence how important the buyer account will be to the supplier, but it will also depend on the size and potential for each account. There could be benefits for economies of scale, but issues arise around confidentiality of the business plans you share with the supplier. Financial reports, typically the last 2 to 3 years of published accounts. They're used as well as the supplier's credit rating. And then analysing potential sales when working on a long-term partnership based around, let's say, generic parts. There'll be more opportunities to generate greater sales growth. And then finally, future expansion opportunities. Supplier may wish to expand their sales opportunities by purchasing more capacity and capability. And having a long-term relationship with a supplier based on trust and commitment will help both sides grow and drive greater sales opportunities. Now here you can see a table of a weighted scoring system, and there are several approaches you can take to assessing the suitability of a key supplier. And it will typically involve weighted criteria. So ideally some things are going to be more important than others. And if you look closely at the example on the screen, quality has a higher percentage weighting than the company profile and the logistics, and environment's quite heavily weighted as well as management. So if a supplier has been asked to complete a pre-qualification questionnaire, then questions can be related to specific criteria, and the responses to these can then be scored. Clearly the ones with the highest percentage are the ones that you would proceed forward with, but some of these could be pass-fail questions as well. Now here you can see the supplier selection models, and there are several techniques you can use to select a supplier. So on the left-hand side, you've got the single models. So mathematics, which include mixed intra-programming and goal and multi-objective programming. So that ends up looking at things like the total cost of ownership, estimating all direct and indirect costs, and AHP, which is a computer-based decision making. You've then got statistical methods, which looks at regression, and artificial intelligence, the theory and development of computer systems that are able to perform tasks normally requiring human intelligence, such as case-based reasoning, a computer-based decision-making approach, and fuzzy set theory, which is an artificial intelligence technique that can be used in supplier selection. And then the combined models on the right-hand side, which has actually AHP and fuzzy logic combined. The linear weighted techniques will include the MCDM methods such as AHP, outranking techniques, data end development analysis, which is a linear programming technique where inputs of suppliers are compared to the outputs to calculate efficiency scores. The efficiency score of the supplier is defined as the ratio of the weighted sum of its outputs to the weighted sum of its inputs. Although this technique has been used by several researchers and there's little evidence of its practical application. So the MAMD, which stands for multiple attributes decision making, which is an approach that helps to rank and select one or more supplier from a pool of providers based on their ratings and weights of precisely known criteria. So it provides an effective framework for supplier comparison based on the evaluation of multiple conflicting areas. Whereas AHP, which you can see down on the bottom under the mathematics, which comes up again in the combined model, stands for analytical hierarchical process, and it's one of the MCDM methods, widely used by researchers and practitioners for complex decisions and to manage the difficulty of determining the performance of suppliers on one criteria alone, or the importance of one with a higher degree of precision. So what it does is it structures the problem in the form of a hierarchy to capture the sub-criteria and the alternatives. And a pairwise comparison is done for all criteria to determine their relative weights, and the alternatives are compared with regards to each criterion. The final score is then generated for each alternative. Thank you for watching. That's the end.